Imagine you are a risk officer at an Indian NBFC, right?
Okay, setting the scene.
Yeah, so it's a Tuesday morning. You've just deployed this state-of-the-art AI model to underwrite unsecured personal loans.
The holy grail of retail lending.
Exactly. And for the first 2 weeks, it's just this massive success. I mean, the system is processing applications in milliseconds.
Right.
Your approval volume is up like 30%, and the cost of acquisition has just plummeted. You're basically celebrating.
Popping the champagne.
Right. But then an RBI auditor walks into your office.
Oh, man, the cold sweat immediately.
Literally the worst nightmare. They sit across your desk and they slide this file over. It's a rejected loan application from, say, a rural micro-enterprise owner.
Okay.
And they ask you a very simple question. They say, explain to me the exact mathematical weight your algorithm gave to this applicant's geographic location.
Yeah, and if you don't know the answer?
Exactly. If your system is just this black box and your only answer is, a panicked shrug because the third-party vendor didn't give you access to the underlying logic, well, your celebration is over.
It's completely over. You're facing severe penalties.
Your firm is staring down the barrel of regulatory fines, and, your career is in serious jeopardy. So today, we are doing a deep dive into this exact scenario.
Because it's happening everywhere.
It really is. You, our listener, are probably navigating this high-speed collision right now. We've got this incredible, rapid technological innovation happening on one side, and then really strict regulatory oversight in the financial sector on the other.
Yeah, India's financial ecosystem is going through a massive, systemic rewiring right now.
Fueled by UPI, right?
Oh, absolutely. The UPI-led payment boom is creating this ocean of data exhaust. Billions of transactions.
Just a ridiculous amount of data.
And non-banking financial companies, the NBFCs, they're racing to ingest all that data, right? Because they want to score these thin-file customers using AI-driven lending.
Which makes sense from a business standpoint.
It does. But it has triggered intense scrutiny from the Reserve Bank of India. The RBI has made it super clear that they will not tolerate algorithmic recklessness.
Right, which brings us to our mission for today. We are unpacking this really fascinating framework from the source material. It's called the Free AI Governance Framework.
Developed by Avijit Saha.
Yes, who is this expert in architecting banking ecosystems and AI-powered lending. We really want to figure out how NBFCs and cooperative institutions can actually adopt this framework.
Because they have to. They don't have a choice.
Right. Okay, let's unpack this. Adopting AI in banking right now, it's like driving a sports car on a winding mountain road.
I like that analogy.
Yeah, the technology is the engine, right? It wants to go 100 miles an hour. But the RBI, they are the guardrails.
Necessary guardrails, to be fair.
Absolutely necessary. But if you don't have a solid steering mechanism, which in this case is governance, you're going right off the cliff.
Straight into compliance risks, operational failures, yeah.
And reputational damage. So how does this framework actually provide that steering wheel, especially for NBFCs, because they face very different challenges than, say, a Tier 1 commercial bank?
Right. That's a crucial distinction. A massive commercial bank, they might have a dedicated AI research lab,
Oh, yeah. Hundreds of data scientists on staff.
Exactly. Custom-built infrastructure that's heavily monitored. But an NBFC or a cooperative bank, they don't have those resources. They rely heavily on third-party SaaS vendors.
Which introduces a whole other layer of risk.
Huge risk.
Yeah.
Plus, NBFCs are fundamentally exposed to higher risk unsecured lending. That's their core market.
Right. They're lending to people the big banks often turn away.
Exactly. So they operate with much thinner margins for error. You can't just copy-paste a generic tech playbook into an NBFC. It's basically operational suicide.
So they need a really tailored, phased approach, not just a reckless tech land grab.
Exactly. And that brings us to the actual pillars of the Free EAI framework. It's an acronym, right?
Right. FREEAI.
Let's start with the S and the R. Fairness and robustness. These are crucial for survival.
Okay, let's dive into fairness first.
Yeah.
Because when I look at this, I immediately see a friction point.
Between what and what?
Between the mathematical reality of machine learning and the regulatory reality of India's financial inclusion goals.
Yeah. The Yandan accounts, priority sector lending.
Exactly. The whole point of those initiatives is to bring the unbanked into the formal economy. But if you train a traditional machine learning model to predict loan defaults, What does it do?
It looks for historical correlations.
Right. And historically, the people who consistently pay back loans have formal salaried employment.
They live in urban PIN codes,
They have extensive credit bureau histories, so the algorithm is naturally going to optimize for those features.
which creates an automated redlining effect.
Yes, automated redlining. And that runs completely counter to the inclusion goals.
Right, because a machine learning model, it doesn't understand socioeconomic context. It just understands statistical variance.
It's just doing the math.
Exactly. If you feed an uncalibrated model 10 years of historical lending data, it's going to notice that, say, micro-enterprises in Tier 3 cities with erratic cash flows.
They have a higher historical default rate.
Exactly. So the model penalizes those geographic and occupational vectors. The algorithm isn't malicious.
It's just historically biased.
Right. But the result is that the NBFC starts systematically rejecting the exact populations the RBI is actively trying to include.
Which is a massive problem. The source talks about the RBI's Fair Practices Code and responsible lending expectations.
Yeah, you have to transform the AI from a tool of exclusion into an enabler of inclusion.
Okay, but here's where it gets really interesting, but also a bit contradictory.
How so?
If an NBFC is already dealing with high-risk unsecured lending, isn't there a tension there? Between the fairness of lending to folks with low credit history and the robustness, the R, in the framework of protecting the firm from defaults.
Oh, absolutely. That tension is the defining characteristic of modern lending.
Like, how does an algorithm actually balance that? You can't just tell it to ignore risk. The NBFC still needs to get its money back, right?
Right. What's fascinating here is that the framework solves this through feature engineering and alternative data calibration.
Okay, walk me through that. What does that mean practically?
So instead of relying on a traditional CIBIL score, which a rural farmer might not even have.
Right, they're a thin file customer.
Exactly. So instead of penalizing that, the engineering team configures the model to heavily weight data pulled from account aggregators.
Oh, like their UPI transaction history?
Yes. They analyze the velocity and consistency of those UPI QR code receipts. So the mathematical adjustment caps the negative weight of having a thin credit file.
And elevates the positive weight of consistent digital cash flows.
Exactly. You're essentially teaching the algorithm a brand new definition of creditworthiness that's specific to the Indian digital economy.
That makes total sense. But wait, the moment you recalibrate the model to approve those thin file customers, you're widening the lending net into higher risk territory.
You're flying a bit blind.
Right. If I'm the chief risk officer, I'm terrified. We're lending to a segment that hasn't been stress tested across a massive macroeconomic cycle.
Which is exactly why the robustness is so critical. Robustness isn't about avoiding risk entirely.
It's about accurately stress testing and monitoring it.
Right. It aligns with the RBI's IT risk and operational control frameworks. You have to recognize that your AI is operating in a highly volatile environment.
The source used a great analogy for this. An algorithm is essentially a map of the world at the exact moment it was trained.
But the Indian market is more like a shifting riverbed.
Yeah, shifting riverbed. The relationship between variables changes constantly.
We call that concept drift.
Okay, let's drill into concept drift because I feel like this is a massive blind spot for a lot of tech teams.
It really is. If you're navigating a shifting riverbed using a map drawn 5 years ago, you're going to crash.
Right. So what's a practical example of that in lending?
Okay, think about a macroeconomic shock to a specific sector. Let's say there's a severe monsoon failure that affects agricultural yields.
Oh, that's a perfect example.
Right, so 6 months ago, a farmer's consistent UPI receipts meant they were a very safe bet.
But today, because of the crop failure, those past receipts are entirely decoupled from their future ability to repay the loan.
Exactly. The underlying concept connecting the data to the outcome has literally broken. That's concept drift.
And if the NBFC isn't actively monitoring for that drift?
The AI will just keep aggressively approving loans in that sector based on the outdated correlation.
Loading the balance sheet with toxic assets. Yikes.
Which is why robustness requires continuous, automated statistical monitoring. The system has to track the real-time incoming data against the baseline training data.
So when the divergence hits a certain threshold, like a sudden spike in late payments in a specific geographic cluster,
The system triggers an alert.
and it demands an operational failsafe, right? You don't just watch the dashboard blink red.
No, you intervene. You might temporarily throttle the automated approval rate for that specific cohort,
Route those applications to a human underwriter.
or tighten the approval thresholds mathematically until market actually stabilizes.
So robustness is like building a really good suspension system. It absorbs the bumps without snapping the axle.
Exactly. And that suspension system has to include rigorous stress testing before deployment.
Like adversarial simulations.
Yes, injecting synthetic anomalies into the data stream, simulating a 30% drop in borrower income or a huge surge in fraudulent identities.
You have to find the breaking point of the model.
Because the RBI expects you to know exactly when your underwriting model will fail.
Okay, so we've mapped out the internal defenses, fairness and robustness, widening the net safely. But that's only half the problem, right?
Right, because eventually the regulator comes knocking.
Exactly. The NBFC has to justify its internal mechanics to an external auditor.
Which brings us to the first E in free AI, explainability.
The transparency mandate. The source makes it very clear that black box AI models are a massive compliance liability.
Oh, absolutely. The appeal of a black box model, like a deep neural network, is its predictive power. It finds correlations a human could never see.
Right, it ingests millions of variables.
But that power comes at the cost of interpretability. Under the RBI's Fair Practices Code, you can't just say, I don't know why we rejected them, the computer just said so.
That's an immediate trigger for regulatory action.
Instant penalty.
So what does this all mean for the tech teams? It sounds like using a black box AI is like a loan officer stamping approved or denied on a file. And when the RBI asks why, just shrugging and saying, gut feeling.
That's exactly what it is.
The framework demands the algorithm show its math homework so it can be graded during an audit.
I love that. Yes, showing the math homework. And the industry's moving toward these post hoc explainability techniques to do this.
Post hoc explainability, like what?
The big one is SHAP values, shapely additive explanations.
Okay, don't lose me in the math here.
I won't. Simply put, SHAP allows an engineer to take a complex model and isolate the exact percentage contribution of every single variable to a specific decision.
Oh, wow. So that translates directly to the decision log the auditor demands.
Exactly. The auditor pulls that rejected MSME application from our intro.
Right.
And the NBFC produces a log showing, okay, the application was rejected, the geographic location contributed -5%.
The lack of a credit bureau score contributed -20%.
But the massive irregularity in monthly UPI cash flow contributed -75%.
Boom! The NBFC can definitively prove it was a mathematically sound assessment of cash flow, not an arbitrary bias against the applicant's PIN code.
The math homework is fully graded, and that ensures smooth audits and regulatory comfort, which is what the RBI wants.
If we connect this to the bigger picture, showing the math homework isn't just about compliance, is it?
No, it directly impacts consumer trust. A vague algorithmic rejection damages your brand, but a specific explainable rejection gives the borrower a pathway to improve their creditworthiness.
Which protects the NBFC from devastating reputational risks.
Exactly, which leads us perfectly into the second E of the framework.
Ethics.
Right. And in the context of the RBI's 2022 digital lending guidelines, ethics is not some philosophical debate. It is a strict operational boundary.
Right, because we all saw the massive fallout from those aggressive, unregulated digital lending apps a few years ago.
It was a nightmare. Algorithms were deployed with a single unconstrained goal: maximize loan recovery at all costs.
And an unconstrained algorithm is just a maximization function.
They don't care about societal norms or privacy laws. If it determines a borrower is 90% more likely to pay if they are texted at 11:30 p.m.,
it's going to text them at 11:30 p.m.
or if it figures out that scraping their phone contacts and texting their employer gets the money back.
It'll do it, and the regulatory backlash was severe.
As it should be. The guidelines now mandate explicit consent architectures and really strict boundaries on recovery practices.
So integrating the ethics pillar means translating those regulatory boundaries into mathematical constraints within the AI.
Yes, it's an exercise in constraint optimization. The objective is still maximize loan recovery, but you build a sandbox.
Hard operational limits.
Exactly. Constraint 1. No outbound communications outside the window of 8 a.m. to 7 p.m.
Constraint 2. You can only text the verified numbers provided in the explicit consent log.
Constraint 3. Frequency cannot exceed 2 messages per day. If the AI suggests a strategy outside those rules, the system automatically blocks it.
It forces the AI to find the most efficient path within a legally safe sandbox.
And you entirely neutralize the risk of a viral social media nightmare about algorithmic harassment.
You treat compliance as the foundational parameter of the code itself, not just an afterthought for a human compliance officer to check later.
Exactly. But here's the harsh operational reality for the average NBFC. Everything we just discussed, alternative data weighting, drift monitoring, SHAP value integrations, constrained optimization,
It's incredibly complex.
highly complex. And the average NBFC does not have the internal engineering talent to build these systems from scratch.
Right, which goes back to what we said earlier. They are entirely dependent on third-party software vendors.
Which brings us to the A in free AI, accountability.
I love this point about vendor management because it highlights a massive blind spot.
It really does.
It's like hiring a third-party caterer for a wedding. If the guests get food poisoning, they blame the couple who invited them, not the caterer, right?
That is a perfect analogy.
So for an NBFC outsourcing to some flashy fintech SaaS platform, how do they practically enforce this accountability if they didn't write the code?
Well, this raises an important question because the NBFC executives always try to point fingers at the vendor when things go wrong,
We didn't write the code.
and the RBI does not care. The regulator's stance is absolute. You can outsource the technology, but you cannot outsource the risk,
The NBFC retains the ultimate liability.
always. So Avijit Saha's framework demands clear internal ownership. The NBFC has to appoint a designated model owner.
Okay, who is that?
It's a senior executive or a specialized technical risk officer. Their sole responsibility is to act as the internal adversary to the external vendor.
So they aren't writing Python scripts, but they need the technical fluency to audit the vendor's API outputs.
Exactly. Before the vendor system is ever allowed to touch live customer data, this model owner has to demand exhaustive documentation.
Like what data sets were used to pre-train the model? What are the thresholds for drift alerts?
Right. And it requires a massive shift in how service level agreements, SLAs, are structured.
How so? Because usually SLAs are just about uptime, right? Like, is the software running 99% of the time?
Exactly. But an AI-focused SLA must include compliance and model degradation metrics.
Oh, that makes sense.
The contract has to stipulate financial penalties if the vendor's explainability logs fail an audit.
Or if the model's predictive accuracy drops without an automated alert.
You have to maintain continuous, aggressive oversight of the black box you purchased.
Okay, so defining accountability and audit-ready processes happens before the vendor plugs in. But the actual plugging in, that's the right integration.
Yes. The theoretical capability of an AI model is totally irrelevant if it can't communicate seamlessly with the bank's legacy architecture.
Right, because we have to look at the reality of legacy core banking systems in India.
Oh man, a lot of these systems were built decades ago.
They operate on batch processing, they reconcile data at the end of the day.
But modern AI models, especially for fraud detection, they need real-time streaming data.
Exactly. If I deploy an AI to monitor UPI velocity for money laundering, the algorithm needs to analyze the transaction the millisecond it hits the network.
If the core banking system only feeds data in a midnight batch file,
The AI is effectively useless. The fraudulent funds have already been transferred to 5 different accounts and withdrawn.
so the integration phase requires building API middleware, layers that can safely extract real-time data from the legacy system without crashing it.
Feed it to the AI and then route the decision back into the workflow.
But the framework emphasizes that integration isn't just about business workflows. It's crucially about regulatory workflows.
Okay, let's map that out. What's a practical example?
Let's use the anti-money laundering, the AML example. The AI flags a cluster of suspicious transactions.
Okay.
In a poorly integrated system, that flag just pops up on a secondary dashboard somewhere.
So a human compliance officer has to manually look at it.
Right. They have to copy the transaction IDs, open a separate regulatory portal, and manually type out a suspicious transaction report, an STR for the Financial Intelligence Unit.
Oh, that sounds miserable. That manual bridge completely destroys the efficiency the AI was supposed to create.
And it introduces massive human error.
Right. So what does seamless integration look like?
The AI's output is piped directly into the compliance infrastructure. When the algorithm flags a transaction, it automatically aggregates the KYC data.
It populates the required fields in the STR template automatically.
Yes. And it just places the fully formatted report in a queue. All the human officer has to do is review and authorize.
That is brilliant. The AI is actively automating the regulatory burden.
reducing overhead while ensuring strict adherence to reporting timelines.
Whoa. Okay, so we have dismantled the entire free AI architecture. Fairness through alternative data, robustness through drift monitoring, explainability through decision logging, ethics through constrained optimization, accountability through vendor SLAs, and integration through API middleware.
The theory is airtight.
It really is, but the challenge now is execution. If a chief risk officer is looking at this blueprint, they can't attack all 6 pillars simultaneously.
No, you can't boil the ocean. It requires a phased internal governance policy.
Right. Which brings us to the playbook section of the deep dive, building that internal governance policy. Step 1 is absolute.
Strengthen governance first, before scaling.
Before a single vendor contract is signed, before one line of code is written, the NBFC has to establish the internal rulebook.
And this is usually a massive internal political battle.
I bet. The chief revenue officer wants the automated underwriting deployed yesterday to capture market share.
The tech team just wants to play with the new models.
But step 1 says the executive board must halt deployment until the model owner is appointed, the ethical boundaries are defined, and the audit protocols are set.
It's a complete inversion of the Silicon Valley move fast and break things mantra.
Right. For Indian NBFCs, the framework says, build the brakes, map the route, hire a co-pilot, and then step on the gas. You build the containment unit before you turn on the reactor.
Exactly. And once that structure is codified, step 2 dictates a prioritized, phased adoption of use cases.
Right, because again, NBFCs cannot boil the ocean.
The framework strongly advises against starting with the most complex, high-risk application, which is automated loan underwriting.
So what's they start?
Target 1 should be fraud detection, specifically monitoring UPI and digital transactions.
Strategically, that makes so much sense. It's the perfect testing ground.
Why is that?
Because from a regulatory standpoint, the cost of a false positive in fraud detection is relatively low.
Right.
If the new AI incorrectly flags a legitimate UPI transfer as suspicious, the customer just experiences a temporary block. It's a minor inconvenience until the transaction clears. The reputational damage is minimal.
But conversely, if you start with loan underwriting and your uncalibrated AI incorrectly denies credit to 1,000 legitimate applicants,
You've violated the Fair Practices Code, harmed consumers, and invited an immediate RBI investigation.
exactly. So by starting with fraud detection, the teams can test their drift alerts, their vendor SLAs, and their API integrations in a lower risk environment.
They build the institutional muscle memory. They learn how to read the SHAP values without panicking.
They learn how to handle alert fatigue from the dashboard.
And they prove to the board and the auditors that the governance framework actually holds up under live conditions.
Right. And only after it's battle-tested on fraud do they move to target 2, loan underwriting.
Where they have to strictly enforce the interpretable scoring and fair practice alignment.
But the internal teams already know how to manage the system by then, so they can focus on the complex risk dynamics.
And then target 3 would be collections analytics.
Deploying those constrained optimization models we talked about to ensure ethical recovery without aggressive targeting.
It's a meticulously risk-weighted progression.
It is. And wrapping around this entire phased approach is step 3, executing the cost-effective strategy.
Which leans heavily on that vendor management strategy we discussed.
Right. NBFCs must leverage RBI-aligned SaaS solutions and fintechs for things like KYC and AML monitoring.
Because attempting to build proprietary infrastructure for that is just too expensive, right?
It's a terrible use of capital. Building a robust AML engine that complies with FIU standards takes millions of dollars in continuous R&D.
And specialized RegTech vendors have already absorbed that cost.
Exactly. The NBFC's competitive advantage isn't in writing better base-level AML code than the vendor.
Their advantage lies in how rigorously they govern, tune, and integrate that technology into their specific customer base.
Yes. Achieve faster digital maturity, reduced risk, and improved compliance all at once.
Man, the philosophical underpinning of this framework really does stand in direct opposition to traditional tech mentalities.
It has to. Breaking things in a photo-sharing app means a server crashes.
Breaking things in an NBFC means systematically denying credit to vulnerable populations, or violating privacy laws with aggressive collections.
Or destabilizing your capital reserves because you didn't monitor for concept drift. The RBI's architecture is designed to punish institutions that move fast and break things.
It's a slower initial rollout, but it's the only sustainable path to scale.
Definitely. Especially as the digital exhaust from UPI keeps expanding And the RBI inevitably tightens AI governance even further.
The gap between the reckless adopters and the governed adopters is going to widen exponentially.
Oh, without a doubt. We are entering a phase of total technological commoditization.
What do you mean by that?
Within 36 months, every single NBFC is going to have access to incredibly powerful, off-the-shelf AI underwriting tools.
The AI itself won't be special anymore.
Exactly. The raw predictive power will just be baseline table stakes.
So if the algorithms are commoditized and every competitor has the exact same engine, the true competitive advantage shifts entirely
It shifts away from the technology itself.
and toward the operational architecture surrounding it, which leaves us with this brilliant quote from the source material. The winners will not be those who adopt AI the fastest, but those who adopt it the most responsibly.
It's a paradigm shift. Governance is no longer a cost center. It's the primary enabler of growth.
It really makes you wonder, in a few years, when every NBFC has the exact same AI, will a bank's true competitive advantage simply be the quality and transparency of its governance framework? Is compliance actually the ultimate feature?
That is the big question. The framework provides the vocabulary to turn that regulatory burden into an asset, but you have to actually do the work.
So to you listening, if you are sitting in that boardroom or reviewing that vendor contract, consider how your own organization is aligning with RBI expectations. Are you ready for the era of accountable AI? The operational boundaries are set. The regulator is waiting. Build the governance first.